Good evening, all the joinees. Hi, this is Ansu. I welcome you all to the webinar conducted by NGEN Markets. By the time the others join in, let's have a look at today's webinar topic. So today we will be majorly focusing on comparison of actively managed fund versus a passively managed fund. For that, firstly, we will be using our screener section and our robust query section to select and shortlist our active and passively managed funds. Next to that, we would be looking upon certain relative returns parameter, which includes tracking error, alpha, beta, and capture ratios. Next to that, we would be looking upon the holding analysis of these funds that we have shortlisted, and then we would be looking upon various reports that you could generate from the platform. Once the webinar is complete, the quorum would be open for a Q&A session. So let us begin. So this is our NGEN Markets landing page. So the landing page would be the Markets tab. For our topic related webinar, we would be moving towards this funds section. Now, this is a section wherein there are two tabs that can be made useful while selecting funds as per your requirement. First is this screener section, and second is this robust query section that we have. Now, in the screener section, which was the part of the platform since the beginning, this, as I mentioned, is a section wherein once you click on this filter categories, you would be able to see various SEBI categories that are available. Now, since we are talking about actively versus passively managed fund, let's say I am trying to look upon only those funds which piggyback or which takes Nifty 100 as a benchmark. Now, talking about passively managed funds, all the passively managed funds would come under the category of equity index fund. Now, how do you go about it in this screener section? You would be required to click on this filter categories as an option. Four buckets would show up, which are typically the asset classes and their SEBI categories. SEBI classification within each asset class will now show up. So our lookout would be for only the index fund. So you could see the category of equity index fund. And once you click on this checkbox, the entire lot of 192 equity index fund will show up onto this screener. Now to locate a fund that tracks Nifty 100 as its benchmark from this list of 192 funds would be a hassle. And in order to solve that hassle, you can use this robust query section. So once you go to this query section, you will be having an option to create in your own query. You just need to give in conditions. Basis that conditions, you build a query and you will be able to see your result of funds. Now, we know that we are looking at a list of equity index fund. So the first thing that you could do is from this select statistic filter option, click on this drop down and select SEBI category as an option. In this, we would be selecting equity index fund, and all you need to do is click on add condition. So basis the first condition, it says that there are 192 equity index fund. Now, the second condition that I would be adding would be a fund name. So any passively managed fund would have majorly the name of the index that it is trying to replicate. So since we are looking upon a fund which piggybanks Nifty 100 as a benchmark, it definitely would have a name, Nifty 100 Index Fund. So what I would be doing is from this drop down, I would select this option as fund name. And in this gray section, I would be writing the name Nifty 100 Index. So I'm letting the system know to give me list of only those funds out of this 192 equity index funds which have the fund name which exactly matches or which contains Nifty 100 index. And now I click on add condition. So basis this one condition of fund name that I had input, you can see from 192, we have come down to just 3 funds which is specific to the list or to the condition that I have input. Now what you could do is simply click on this show 3 funds, and the list of fund that has gotten shortlisted now comes up on the right hand side. Now before completing this query, I would also want to input one another condition, which apparently is the age of the fund. So let's say I want only such Nifty 100 index fund who have been in the market for at least 5 years. So I'll be clicking on this drop down, selecting launch date as an option, and I would be editing the end date, and I'll be making it as 27th Feb 2020. And then I'll click on add condition. Right? So basis all these 3 conditions, it now says that there is just one fund meeting my required condition. Once I click on that, I am with my fund name, which is Axis Nifty 100 Index Fund. So our hassle of manually looking for a Nifty 100 Index Fund from a list of 192 equity index fund is now completed within few seconds using this query section. Now for comparing this passively managed fund with an actively managed fund, you will be required to move this fund to the compare section right below the fund section, and that is possible by clicking on this compare icon. Once you do that, your list of funds, if there are any, that gets moved. Currently there was a single fund and that has gotten moved to this compare section. Now, before looking upon actively managed fund, one more thing that you could do in this query section is this option of saving this query. So rather than coming onto the platform and creating this query over and over again, all you can do is save this query. Just simply click on save query. Once that is done, the next time you come onto the platform, you can simply go to this load saved query, select the query that you have saved, and the conditions accordingly come up, and the funds will also come up once you click on show the number of funds. So this is how we shortlisted and looked upon our passively managed fund. Now, an actively managed fund that, let's say, takes Nifty 100 as a benchmark would be large cap as a category. So in large cap as a category, I do not wish to create any range. All I want is the fund which has given in the best 5 years return in that category. So for that, I would be using this screener section. So the process remains the same. I click on this filter categories. I would untick equity index fund. I would select large cap fund, and the entire lot of 32 large cap fund will show up onto this screen. So as I mentioned, I want to shortlist this list of funds basis the 5 years return. So rather than scrolling towards the right, which is an option to do, we have these preset column views. You could click on this drop down and select return columns. So only the return specific columns would come up. And now I would be locating this 5 years return. I'll just click on this column heading to sort this in descending order. So the best 5-year return has been generated by Nippon and iPro. So I would be taking these 2 funds now to the compare section. Now, how do you move them is just next to the name of the fund. Towards the left hand side, there is this compare icon which says add to compare. I'll simply click on this compare icon, and these 2 funds have now gotten added to this compare section. So now we have this passively managed fund, which is Axis Nifty 100 Index Fund, and our 2 actively managed fund, which piggy banks Nifty 100, which takes up Nifty 100 as its benchmark. Now, let's say I also add in benchmark as a parameter, and then we go forward with a detailed analysis. The option to add a benchmark would be available right here, add other items. So I would search for Nifty 100. Once you click on that, it gets added in as a row item. So here you could see there is a color differentiation. This is just so that there can be an identification that this blue color coded section is representing the index, while the white section is representing that of the fund that you're looking upon. Now, the first parameter when you look upon these funds, which is passive as well as active funds, would be the expense ratio. the amount that is required to manage that fund. And on the platform, you could find it mentioned as TER, an abbreviation for total expense ratio. So you could see that for both our actively managed fund, which is Nippon India Large Cap Fund, and iPro Blue Chip Fund, the tracking error is considerably or comparatively higher at 1.5% for Nippon India and 1.4% for iPro Blue Chip, suggesting that the fund manager is trying to do something different than that of the benchmark, while for this passively managed fund, which has an expense ratio of 0.92, it is simply trying to replicate the performance of the benchmark, and hence the tracking error of passively managed fund would tend to be lower. Now, talking about relative data respective to each of these funds, to allocate them or to locate them, you need to scroll towards the right hand side and locate these pink color coded columns. So these are the columns that you can see are currently blank, which are the relative returns specific columns. Now, in order to activate them, you need to click on this checkbox of relative returns. Once you do that, your data gets populated. However, by default, the benchmark that gets selected for these relative returns would be Nifty 50. You could simply search for your respective benchmark. So I would select Nifty 100. And next to that, you have an option to set in a start date. So let's say I try to analyze these data for each of these funds, maybe for the past 5 years. So I would select, let's say, 28th Feb 2020. And now we are able to view the relative data for each of these funds against Nifty 100 as a benchmark for the past 5 years. Now, the first parameter that you come across is mentioned as cumulative excess. So, as the name suggests, cumulative, which is absolute or rather point to point excess return that is generated by each of these funds over and above that of the benchmark. So you could see for this active funds, which is Nippon India Large Cap Fund, the cumulative excess is 39%, while again for the iPro Blue Chip, it is to an extent of 35%, suggesting that the strategies adopted by the fund managers had indeed worked in favor of these actively managed funds, because they are able to generate excess return over and above that of the benchmark. While if at all we look upon the cumulative excess for this passively managed fund, it is to an extent of 0.28% only. So there is no such extra effort that is put in by the fund manager in trying to outperform the benchmark, because the objective of these passively managed fund is to just piggyback the performance of the benchmark. Next to that, you can look upon annual excess. So how do we arrive at these annual excess? It is a plain division of this cumulative excess with the total number of years that is under consideration. So on an annual basis, what is the excess return that is generated by each of these funds is what it denotes. So typically 7.8%, how do we arrive at that? It would be 39.5% divided by the time period that is under consideration, which is like a 5 or a 5.5 years that way. And that is how we arrive at this annual excess as a parameter. Next to that, we have this beta as an option. So beta lets us see how riskier or how sensitive the fund is when you compare it to that of the benchmark. So the beta of a benchmark with itself will always be 1. And that is what you could see. And we say a beta lesser than 1, let's just say that the fund is less riskier than that of the benchmark. So here, if we look upon for this passively managed fund, which is Axis Nifty 100 Index Fund, its beta is very close to that of the benchmark. The beta for this fund is at 0.98, while for the benchmark it is 1. So you can see that their risk parameter is as well closer to that of the benchmark. There is nothing different done by the fund manager. While for our actively managed fund, you could see two different betas. So for this fund, Nippon India, Of course, the beta is higher, meaning the fund is taking in higher level of risk, but this higher risk is anytime compensated with the higher level of return or the excess return that the fund is able to generate. While if we look upon for IPRU, the risk is comparatively lower for this fund, but at the same time, the return is that way a bit moderate for this fund. So, although Nippon as a fund, active fund, is taking in a higher level of risk, it is also compensating it by generating a higher level of return. Next to that, the other parameter is tracking error. So, as the name suggests, how effectively and efficiently the fund is tracking the performance of the benchmark. Tracking error becomes effective majorly when we are looking upon a passively managed fund. So, tracking error is calculated as standard deviation of excess return generated by the fund against that of the benchmark. So, tracking error for an actively managed fund would anytime be higher because the fund manager is trying to do or input certain strategies so that the fund will be able to beat the benchmark and given an outperformance. And that is what we could see right here for both our active funds. The tracking error is indeed higher. While for our passively managed fund, the tracking error is considerably lower. So, this passive fund has a lower tracking error, and you could say that that is attributable to the expense ratio of the fund. So, if there would have been no expense ratio, this tracking error would have been very low for this passively managed fund. Next to that, we have this parameter called as information ratio. So, information ratio is calculated by taking the ratio of annual excess with tracking error. So, information ratio can show you the skills of the fund manager. So, if the alpha annual excess, if the alpha is positive, suggesting that the fund is outperforming the benchmark, the information ratio would also be positive. Higher and higher is the information ratio, better would be the fund manager's strategy, and you could say that the strategy is indeed effective as the fund is able to beat the benchmark. And in the other way around, if the alpha is negative, that is, the fund is underperforming the benchmark, the information ratio would be negative. So here we could see that for this passively managed fund, the information ratio is like negligible or to an extent of 0.03%. That is because the excess return is very low or rather very negligible, and hence the index fund has like a zero information ratio. Next to that, there are two other parameters that you could look upon, which are these capture ratios, up capture and down capture. So up capture ratio lets us see how is the fund performing when the benchmark was in a bull run, and down capture ratio lets us see how was the fund performing when the benchmark was in a bear run. Now, in order to understand these two ratios in detail, we would load a fund in a new page. So let's say I load this iPro blue chip in a new page. So before looking upon or locating the capture ratios, I would change the time period that is under consideration. I would take in 2020, 28th Feb. And in this fund performance section, if you scroll down, versus Nifty 100, you would be able to see multiple parameters, which is the cumulative excess, tracking error, information ratio. And here comes the up capture ratio. So once you hover on any of these question marks, an explanation for each of these data is anytime provided. So for this fund, iPro Blue Chip, you could see the up capture ratio is to an extent of 98%. Now, how do we arrive at this 98%? You can just click on this I button and it can give you an explanation for the same. So while calculating up capture ratio, we would consider only those months when the benchmark has generated a positive return. irrespective whether the fund has generated a positive or a negative return. For example, in the month of November 2024, the benchmark generated a positive return of 0.08%, while the fund generated a negative return of minus 0.15%. So we have considered this time period to be calculated in the upcapture ratio because consideration is given to the benchmark return. So once we have all these month on month data, when the benchmark generated the positive return and the corresponding return generated by the fund, we would be taking their CAGR. So the CAGR for the fund comes up to be 59.8%, while for that of the benchmark comes up to be 60.7%. Now, just looking at this data, you could say that when the benchmark was moving up by 60.7%, my fund moved up by only 59.8%. So, of course, there is a slight difference, but the benchmark was moving better in consideration to that of the fund. Now, this figure of 98, how do we arrive at this figure? It is a plain ratio of this fund return 59.8 divided by the benchmark return, which is 60.7. And we say higher is the upcapture ratio, better is the performance of the fund against that of the benchmark. And by higher mean, more than 100. And similarly, converse is the down capture ratio. So here we see the resilience of the fund when the benchmark is in a bear run. Now here as well, the explanation would remain the same. However, here we would consider only those months wherein the benchmark has generated a negative return, irrespective whether the fund has generated a positive or a negative return. Once we have all these months and the data respectively, we would take in a CAGR of this data set. And right here, you see the CAGR for this fund comes up to be negative 30%, while for that of the benchmark comes up to be negative 36%. So here itself, you could see that when the benchmark was falling down by 36%, your fund fell down only by 30%. So there is some amount of resilience in this fund when the benchmark was in a bear run. And the data that you see right here, 82%, this as well is arrived by taking a ratio of this fund's return with that of the benchmark return. And for down capture ratio, we say lower the better. Lower meaning it has to be less than 100. So we say up capture to be more than 100 and down capture to be less than 100 because we consider the benchmark to be at 100, and so the up capture more than 100 more than the benchmark and down capture less than 100 less than the benchmark. So this was the explanation for the capture ratio that we looked upon. Now talking about the next topic, we would be moving towards position overlap. Now, position overlap lets us see the common stock holding between every two fund that you have loaded in this compare section main list. Minimum common underlying is what we would be showing here. So we have given you various color coordinations right here, 0 to 20, 20 to 40, 60 to 80. So as soon as your overlaps keep, or rather as soon as the overlap keeps on increasing, the colors of these overlap changes or rather becomes much more darker, suggesting that decision needs to be taken to keep either of the two funds in the portfolio as they have a higher level of overlap with each other. So currently, since we are looking at a list of only large cap funds, we would be seeing that they have a greater overlap because there is a list of only 100 stocks into which they could invest. Now, how do you interpret or read any of this data? Let's say I have kept my cursor on this tile of 59%. So two funds gets highlighted, one on the left and one on top. So on the left, you can see iPro blue chip gets highlighted. And on top, right here, you see Axis Nifty 100 index fund gets highlighted. So this says that both these funds have similar portfolio to an extent of 59%. So you could click on that tile in order to view the detailed split of this overlap. So first thing that you could see is all these stocks that are common for both of these funds. which is iPro Blue Chip, and Access Nifty 100 Index Fund. So, for example, let's say I read out one of this data. For example, HDFC Bank is a common stock between both these funds. iPro holds HDFC Bank to an extent of 9.20%, and Access Nifty 100 Index Fund holds HDFC Bank to an extent of 10.07%. Minimum out of these two holdings is what we mention in this overlap column. And once we total this overlap column, it comes up to 59%. And that is exactly what we show you onto this tile-like structure. Once you click on this tile-like structure, it gives you a detailed split or a detailed explanation for that of the overlap. Now, talking about overlap, you would consider that this index fund that we are looking upon would anytime have a number of 100, or let's say round about 100 stocks or underlying should be there in this fund's underlying holding. So you can also check and verify that in our main list. All you need to do is scroll further towards the right to locate these blue color coded columns, which are called as the holdings column. So there is this fifth column that you could see, and clearly you could see that this index fund has a holding of 103. Numbering of holding is 103, while our actively managed fund have an holding which ranges between, let's say, a 75 to 80%. So you could say that these active funds, even with a lower number of holdings, were able to generate a better and a higher return than that of a passively managed fund. Now, if you wish to download these holdings of each of these funds that you have loaded into this compare section into one Excel sheet, you could make use of this bulk download option. So once you select or download this Excel, this is how the Excel report will come up. Right? So for each of these fund, what all were their current holdings is what you could see. So you can select your respective funds as well. So I would just filter this list. Right? So you can select your respective fund. Let's say I'm just looking at the index fund and I just want the holdings of that index fund. So currently you're looking upon the 103 holdings for this index fund, which is Access Nifty 100 Index Fund. You could view their latest data and their percentage holdings. Now, this latest data, you could be viewing it for the previous month, which is as of 31st Jan 2025. So our update cycle runs from 8th to 13th of the month. So by 14th, you would be able to see the latest data for each of the fund that you have loaded in. After this, the last topic that we have for today's discussion is this risk versus return scatter plot. Now, this is a scatter plot wherein on the x-axis, you could see annualized risk, which is standard deviation. And on the y-axis, you could see annualized return. And the scatter plot is divided into 4 quadrants: low risk, high return, low risk, low return, high risk, high return, and high risk, low return. Now, if a fund gets plotted on this left-hand side of the scatter plot, those would be the ones taking in lower level of risk in comparison to if a fund gets plotted on this right-hand side. Those would be taking in a higher level of risk. And in a similar way, if a fund gets plotted on the upper end of this y-axis, those would be taking or generating higher level of return in consideration if it gets plotted on this lower end of y-axis. Those would be giving in a lower level of return. Now, depending on the time period that you set in, you could view the risk and returns of each of these funds in this scatter plot. So let's say here as well, I take in a time period of 5 years in the past. So I would select 28th Feb 2020 and I'll click on go. Right? So clearly here you could see iPro happens to be on the left hand side, meaning it is a fund in this time period of 5 years, which is taking in lower level of risk, but is able to generate like a higher level of return. It happens to be in this low risk, high return quadrant. While if we look upon Nippon, it is indeed taking in higher level of risk. That is what we had seen even in the main list section that we were analyzing. The fund is taking in higher level of risk, but this risk is anytime compensated by the returns that it is generating. Now, if at all we look upon this index fund, which is Axis Nifty 100 index fund, and this benchmark of Nifty 100, you might think that they are getting plotted at a very distant place from each other. But that is not the case. If at all you look upon the x axis, our x axis is ranging between 17.4 till 18.8. So it is just like a 1% difference. So these two funds, since our x axis is split over a very small risk parameter or a risk percentage, you can see that they are getting plotted at a different end. However, the risk and returns for the benchmark as well as this passively managed fund is near about or closer to each other only. Right? Now here the last option, wherein the report generating option, the report that you could generate from this compare section is a PPT. So PPTs that you could generate from our platform would be edited and would be co-branded in the premium version of the platform. So the first page that you can come across will give you basic information about the fund. Followed by you can view the risk and return specific details for the funds. Next would be the scatter plot of risk versus return. Followed by is the holdings, the split of each fund into large, mid, and small cap. Next being the position overlap, the performance chart showing you the NAV movement of the fund when they are rebased to 100, and followed by are the returns chart. So this relative returns chart, this was something that was newly added as a feature in this PPT option. Initially, the relative returns were not downloadable in this PPT. This is a new slide that has gotten added into this compare section PPT. And as I highlighted, PPTs on our platform are editable. So you could add in slides, add in any comments or any scenarios that you've created into this PPT slide section. So that is it for the topic related webinar. If anyone has any questions, you could either unmute yourself or type down your questions in the chat box. Any questions, please let us know.
Okay, doesn't look like there are any more questions. Let's close for today.
Yes, sir. All right. Thank you all for joining in. You could anytime visit our YouTube page. We have a dedicated playlist for all the webinars that have been conducted up until now. A total of 149 YouTube videos have been uploaded. Thank you all for joining in. Hope to see you again next week with a new topic.